Good afternoon and welcome to the Wealth of Advice market update on the 28th of January 2021. So quite a lot's happening in world news, UK news all the time. Markets are still quite volatile. We've had a couple of negative days, market returns this week, and then today I looked, most markets are positive today, but we're definitely going through a period where any news, negative or positive, is making the market move every day. It's still in a much wider fashion that we perhaps would like. The main news to look at right now is what's going on in the UK in respect of how we're rolling out the vaccine and how quickly it's perceived that the vaccine will be rolled out to everyone, and therefore how quickly the markets will grow on the back of what we believe will be our economy picking up and hopefully growing. You might wonder why Glastonbury being cancelled for the second year in a row is important to that, and what it has to do with your investments. Well, Glastonbury being cancelled was because they have to put their kind of order in, if you like, for all of the suppliers by the end of January, and they would have only done that if they had reassurances from the government, if they believed that they could have a mass attended event at the end of June, and clearly the government has told them that that's not going to be possible. So therefore this return to normality, if you like, is not going to be around in June. It's going to be a little bit later. So when you're hearing stories like that come out, you can understand why the markets in the UK did have a bit of a wobble over the last few days, because it's that belief that as I say, this return to normality is put back a little bit. That said, reasons to be positive. The vaccine is now being rolled out, and the UK is getting praised the fact that we are vaccinating more people than certain other countries. You will see in the news right now the European Union and their leaders are not very happy with the amount of doses that we've got on order from AstraZeneca's site in Belgium, and they're looking to put restrictions and blocks on that. The UK announced this morning that one of the various vaccines that's being produced, one that Scottish companies about to get authorization to produce, is going to produce however many million doses. So it's believed that we have more than enough doses coming to the UK to vaccinate our entire population, and so much so that we'll then be able to share more doses with other countries around the world. So I think if the UK carries on in that vein, and gets more people vaccinated, our economy comes back online quicker, we start getting back to a level of normality we're used to, things will grow. You should see a positive return on your UK investments this year. And as I say, I think I said on the last update that if you look at the performance of UK investments from November last year when the vaccine was first announced, and then the Brexit situation getting sorted, things have been positive and have grown since then. Other positive news: Nissan have committed its long-term future to the Sunderland plant. They are going to build the Qashqai SUV there and start beginning to produce battery-powered cars. And because of this, they'll qualify for a tariff-free export to the EU. So that's good. It's good for the northeast region where the majority of people watching this will obviously live. But it's good in general for the UK market and the UK economy. Those horror stories that post-Brexit a lot of these car manufacturers might disappear into Europe, totally unfounded. UK inflation doubled to 0.6%. High inflation is not what we want, but good inflation, positive inflation, shows that prices are coming back up because people are purchasing it, and that sort of inflation is going to be good. But obviously it's rising because inflation fallen so low last year. So that's the main UK news. Obviously across in the US, Donald Trump is going to be impeached for the second time, confirming the date that trial is likely to start, and there's talk that it might not lead to an actual conviction. But it shows that we are now past the Donald Trump sort of era of presidency, with negative tweets coming out and those spooking the markets. Biden already is talking to allies around the world to try and bring back together, like the climate accord deal, speaking with the UK. I saw that he's going to be he spoke with the Russians and tried to put them in line for some of the things that they were doing last year that Trump just didn't even mention. So hopefully world order is kind of resuming, and that should be positive for markets as well as we go forward. And in the first few days of Biden's presidency, he's done quite a lot. He's reversed some of the more controversial Trump policies. He's actually, quite surprisingly, I think, if depending which way you look at it, he extended the America First policy that Trump brought in, which was American companies or American government agencies should be buying American products more often than not. That was obviously seen as a quite inward-looking policy from Trump, and Biden's extended that. They are looking to bring in a 1.9 trillion stimulus package to help the US economy recover. So that should be positive for markets. We are looking to see what's going to happen with the UK-US trade deal. How long will that take? We don't know. But it's good that Biden rang Boris Johnson quite early in his presidency. Over the course of January, it's historically a month that we will speak with fund managers more perhaps than any other month of the year, as fund managers want to get their message across to us as to what they think 2021 is going to look like. Now, since the coronavirus caused markets to collapse last February and March, we've had more contact with fund managers anyway, as I was on a call only an hour or so ago with Janus Henderson again. That's a couple of times I spoke to them the last few weeks. We're getting really good access to their fund managers. But overall, the message we want to get across to yourselves is that fund managers are very, very positive on where they think 2021 is going to go for investment returns. The UK outlook is much better than what it was, say, 6 months ago. Obviously, the Brexit deal and the vaccine we keep mentioning. And what you're now starting to see in the UK is lots of mergers and acquisitions. You're going to see lots of companies come to the market to float, which should mean that the markets actually go up this year, and strong recovery is forecasted in the UK during 2021. So all the main fund management groups we spoke to were positive about that. Interesting discussion we had with Janus Henderson about interest rates. Interest rates are so low because they need to be low for the economy to recover and the economy to grow. The government right now has such a high amount of debt that if interest rates were to rise, the government may get into difficulty repaying its own debt, so to speak, because the interest payments will be a lot higher. So basically the thing there was, don't expect interest rates to rise probably over the next decade. So those clients who have high cash balances, unfortunately, you're not going to see interest rates improve anytime soon. I was talking to somebody yesterday who had a cash investment with a bank that was generating 1.9% a year. I think that will be something that you won't see in the next, I mean, that was something that was set up a while ago. It's going to mature, I think, in the next few months. You're not going to see those sort of rates offered by banks again anytime soon. The first chart we're showing today shows the rate of increase in COVID cases in the UK and the US after Thanksgiving in the US, which is the end of November, and then kind of after Christmas. 2 periods of the year where families come together. Obviously the holiday season, as they call it over there, but the 2 periods of the year where families come together, obviously the winter months where more people are indoors. You did see a big spike in the COVID cases. The positive thing to look at this is that both graphs, you can see there, both lines, they are coming down. So this is I believe that the main reason why our government increased the lockdowns and the tiers were increased was they knew that this spike was coming to try and ease pressure on the NHS. Hopefully, as we start to we're at the end of January now, we're almost in month 2 of the year, get February out of the way. I know the schools are touted to reopen early March. Hopefully by that time, the rate of infections go down, the hospitalisation go down, and then, as I say, get more people vaccinated and the economy should start reopening. The speed of vaccinations coming through, as we said, this graph shows, will allow the economy to reopen faster. And clearly, I know, as I've said this to a couple of clients during telephone calls, obviously this is not nice for those poorer countries around the world who can't get their populations vaccinated, because more people in those countries will die and be sick and unwell. But the UK gets its population vaccinated quicker. It means that we can reopen the economy faster, and then we'll all sort of benefit through our pension investment valuations going up, and we can all feel more confident in what the future looks like. The big problem would be then what happens in those poorer countries, because if they don't get vaccinated, those people will still be able to spread the illness, and it might come to the UK. So we have to see a more global approach on this. I think at the moment you're seeing a lot of insular sort of comments come out. The Europeans want their people doing, the English want their people doing, which you can understand, but I think there needs to be a global sort of look at that to make sure that those people who need the vaccines are getting it, and as I said, it's a global approach. So this graph that we're putting up now shows the performance of the various world stock markets during the month of January, and as you can see, the FTSE 100 had a good opening, few days to the month, rising quite rapidly and was the best performing index by a long way. FTSE 100 fall over a good few days, still the best performing index over the month, but it is a little bit worried about how much it came down there. The MSCI index, which is obviously global stocks kind of combined, running along the same sort of line as what the US has done. But again, for those clients, if you remember, towards the middle to the autumn of 2020, who were perhaps saying, let's take us out of the FTSE 100 or take us out of the UK. As I say, Royal London have a big exposure to UK. We've got obviously UK stocks and funds in our model portfolios. Those clients who were saying, take me out of the UK and go all in the US, you can see that, as I say, the one stock market doesn't dominate forever, and good positive returns are generated from having a good balanced portfolio. Then obviously look at the total performance of the indexes over a full 12-month period. FTSE 100 still not back to where it was at the end of February, got closer than it's ever been, so to speak, early mid-January, but then fallen away again, and still well behind the US and the world index there over 1 year. Over 3 years, still negative territory right now. We did get positive territory, and then over 5 years, whilst the UK market is positive, you can see it still lags behind those other market indices. A lot of commentators are saying that there's certain parts of the certain parts of the UK stock market are very, very cheap to buy right now, and the UK is definitely a buy signal for lots of fund managers because they think our funds are cheaper. Again, we see mergers and acquisitions happening because stocks are cheap, and you're going to see companies go to market to offer their shares to market for the first time, IPOs as they're called, and that will see the markets kind of rise. I'm quite positive as to what the next few months may look like from a market point of view, provided these lockdowns don't go on for too long. A graph that we've shown in the past, the VIX index, the volatility index, showing it over the last 15 years. You can clearly see how the spike last February mirrored the spike in risk as to what you saw the financial crisis of 2008. And as you can see, after 2008, there was spikes along the way when it went back up before it went down to historic low levels. Because 2020 was such a quick sort of shock, if you like, that's why you're seeing these little spikes back up. Anything that comes out now that spooks the market, you're seeing a spike in risk. But thankfully, we're nowhere near those levels that we saw back in February. But it's just a warning to say that volatility is still higher than its historical levels, and we do need to keep an eye on it. So although we are trying to give a positive story as usual, what we are also saying is we're just going to keep an eye on risk, and we will be looking to take risk down wherever necessary as we go forward. But right now, just as a bit of a reassurance to everyone watching, no matter where you have your funds invested, we are confident that we have you in the right places, and we don't want to make any fund changes to anyone's portfolios right now. We're comfortable with where we are with that. Some more charts that you might find interesting. This one here, the Global Manufacturing and Services Output Index. It's a bit of a mouthful. You can see during 2020, absolutely collapsed, fell off a cliff. As all the major economies around the world all went into lockdown. Obviously, I know people in the UK are still feeling in lockdown, but various parts of the world have come out of lockdown and are starting to trade normally again. So you can see that cliff edge was felt during 2020, but we're now back above, or back at the level kind of we were from a global output point of view than where we were before the crisis started. If you now look at the global output per sector chart that you can see now, you can see that the green bars at the top are all sectors that are now growing again, and the index, the output index, is higher than what it was the previous year. The red ones at the bottom, the obvious ones to note, are negative. Tourism and recreation, transportation, the bottom two, which you might say, well, that's pretty obvious because people just can't travel and go on holiday and do the things that they might have done previously. But again, I'm sure as the year unfolds, those red bars will start to shrink. So thanks for listening to another Wealth of Advice market update. We'll be back in touch with a further update in a couple of weeks' time. Rest assured that me and the team, Jordan in particular, will be speaking with lots of fund management groups in the coming days and reporting back on what we hear from these people. Last year we had a seminar at the Ramside in Durham where a lot of our clients attended the 2 sessions that we had. Obviously we can't do that this year because of we just can't do it this year, obviously. And what we're doing instead is having an online webinar. Invitations for that are going to be sent out very soon with instructions on how you can join that and what the content's going to be. So I hope many people who watch this will be happy to come online and see us provide a webinar where we will be presenting various presentations that we're going to get various fund management groups to record for us. If anyone has any key questions that they would like to ask us, which we can pass on to the fund management groups, please send us an email or through the PFP, however you get in touch with us, and we'll certainly raise those. So thanks again for listening, and as usual, if you need anything else, just get in touch.